When it comes to crypto investing, dollar cost averaging is not only one of the most beginner-friendly strategies, but also potentially one of the most lucrative. This time-tested approach has been used by investors across generations, with significant results in traditional finance. Yet, the unique opportunities and volatility of the crypto market can amplify dollar cost averaging's benefits in ways that could outperform more conventional investments. In this video, we'll break down everything you need to know about dollar cost averaging and how you can use it to develop a portfolio that can withstand market swings and perhaps change your financial future. What is dollar cost averaging? Dollar cost averaging, commonly abbreviated as dollar cost averaging, is an investment approach where investors buy a fixed dollar amount of an asset at regular intervals, regardless of price. This strategy is particularly useful in volatile markets like cryptocurrency, where prices can fluctuate drastically even within a single day. Dollar cost averaging helps investors avoid the pressure of buying at the right time by spreading their purchases across different price points. For example, an investor might choose to invest $100 in Bitcoin on the first of each month. This means that when the market is high, they'll buy fewer coins, and when prices drop, they'll buy more. Over time, this balances out the cost per coin, potentially leading to a lower average purchase price. In traditional stock markets, dollar cost averaging has been shown to mitigate risks associated with market fluctuations, making it a trusted strategy for long-term growth. Why do investors use dollar cost averaging? Investors are drawn to dollar cost averaging for several reasons, the most significant being its ability to simplify and stabilize their investment approach. Instead of reacting to daily price movements, dollar cost averaging investors commit to a steady, methodical purchase plan, which can provide similar returns to active trading without the need to spend hours monitoring the market. Studies from Morningstar and Vanguard on stock market returns have shown that dollar cost averaging, while potentially yielding slightly lower gains than perfect market timing, offers a balanced trade-off for risk reduction and emotional resilience. In a field as volatile as crypto, where assets like Bitcoin have seen price fluctuations of over 20% in a single day, the emotional burden of constant monitoring can be overwhelming. For many, dollar cost averaging's set it and forget it approach is both financially effective and emotionally calming, as it removes the stress of timing entries and exits. Another advantage of dollar cost averaging is that it minimizes the emotional reactions to price dips or surges. Instead of feeling the need to buy or sell based on emotions, investors following a dollar cost averaging approach stick to their plan regardless of market noise, which can help them avoid costly mistakes. Dollar cost averaging also promotes disciplined saving habits by enforcing regular investments. This commitment to consistency can foster better financial habits, especially for those just beginning their investing journey. Dollar cost averaging's popularity in crypto also stems from its accessibility, with most major exchanges offering tools that automate recurring purchases, making it easy for newcomers to participate in the market without extensive trading knowledge. How popular is dollar cost averaging in crypto investing? A recent survey conducted by Kraken's Learn team gives insight into the popularity of dollar cost averaging among crypto investors. According to the survey, 59% of crypto investors use dollar cost averaging, and 83% have employed it at some point in their investing journey. One of the main reasons cited is the desire to minimize volatility, with 46% of respondents identifying this as their primary motivation. Other reasons include building consistent investment habits and reducing the influence of emotions on trading decisions. For many, the allure of crypto lies in the potential for high returns. However, the risk of sudden drops makes it essential to adopt a strategy that manages both risk and reward effectively. With dollar cost averaging, investors can ride out the peaks and valleys of the market with less anxiety. The impact of income on dollar cost averaging strategies. Income level plays an influential role in an investor's approach to dollar cost averaging, as shown in Kraken's survey. The survey revealed that high-income investors, those making over $200,000 annually, overwhelmingly prefer dollar cost averaging, with 77% of this group using it as their primary investment strategy. By contrast, only 14% of high-income investors attempt to time the market. At the other end of the spectrum, Lower-income investors often feel compelled to take more risks, with a larger percentage attempting to time the market for potentially higher, faster gains. For instance, among those earning less than $10,000, about 26% try to time the market. Investors with higher disposable incomes are generally more comfortable watching their investments fluctuate, as they can afford to let their assets grow over time without the need for immediate gains. On the other hand, lower-income investors might feel pressured to maximize returns as quickly as possible, which can lead to higher levels of stress and impulsive decision-making. This trend illustrates how dollar-cost averaging can be adapted to suit different financial situations. Higher-income investors often find dollar-cost averaging attractive because it aligns with a long-term wealth-building strategy, while those with lower incomes may need to focus on short-term gains, even if it means assuming more risk. Examples of dollar-cost averaging success in crypto. To illustrate the potential of dollar-cost averaging in crypto, let's consider some hypothetical scenarios where an investor commits to investing $10 daily from January 1, 2020 to January 1, 2024, totaling $4,620. If invested in Bitcoin, the portfolio would have grown to around $13,670, more than doubling the initial investment. For Tron, the portfolio would have reached $38,231, significantly outperforming Bitcoin. A dollar-cost averaging approach with Binance Coin would have yielded a portfolio worth $72,315, representing nearly a 5x return. Even meme coins, such as Dogecoin, would have provided impressive gains, with an ending value of about $142,450. Solana stands out with the most striking growth, as the investment would have reached approximately $366,361 by early 2024, marking a remarkable 20x increase. These examples highlight how dollar-cost averaging can capitalize on the long-term growth potential of various crypto assets. While actual returns depend on market conditions and are not guaranteed, these hypothetical scenarios underscore the impressive potential dollar-cost averaging can offer over time. Variations of dollar-cost averaging strategies. Although dollar-cost averaging is a straightforward strategy, several variations exist to suit different risk tolerances and goals. For instance, dynamic dollar-cost averaging, also known as value averaging, involves adjusting the amount you invest based on market conditions. In a bear market, an investor might increase their contributions, while in a bull market, they could invest smaller amounts to reduce risk. This approach requires a bit more attention to market trends, but can yield higher returns while controlling risk. Another variation is micro dollar-cost averaging, where investors contribute very small amounts on a daily or even hourly basis, further smoothing out the purchase price. Micro dollar-cost averaging allows investors to spread their purchases even more evenly, which can be advantageous in a highly volatile market like crypto. Alternatively, macro dollar-cost averaging involves larger, less frequent investments, like $500 monthly rather than small daily purchases. Macro dollar-cost averaging appeals to investors who prefer a hands-off approach, as they don't need to commit to daily or weekly contributions. Each variation of dollar-cost averaging allows investors to tailor their approach to their budget, risk tolerance, and market outlook. Whether you choose traditional dollar-cost averaging, dynamic dollar-cost averaging, or micro-macro dollar-cost averaging, the fundamental advantage is consistency, which can ultimately lead to better outcomes over time. Why not lump sum investing? Investing a lump sum can yield higher returns in a bull market, but it also carries more risk, especially in volatile markets like crypto. Lump sum investments depend heavily on timing, and missing the perfect entry by just a day could mean buying at a peak, which can lead to substantial losses. Dollar-cost averaging helps spread out the risk by dividing your investment across multiple entry points. It reduces the need for perfect timing, which is challenging even for seasoned investors. Financial experts like Vanguard and Morningstar have noted that while lump sum investments may outperform dollar-cost averaging in perfectly timed conditions, dollar-cost averaging's consistency and risk reduction make it the preferred choice for investors who prioritize stability over high returns. Dollar cost averaging can also alleviate emotional reactions to market dips, as it removes the pressure to decide when to buy in a constantly fluctuating market. For long-term investors, the slower, steady returns from dollar cost averaging often outweigh the risky potential gains from lump sum investing. How to get started with dollar cost averaging. Getting started with dollar cost averaging in crypto is simple, thanks to the variety of automated tools available on most major exchanges. You can choose your asset, select a recurring investment schedule, and set the amount you wish to invest. Many platforms allow you to set it and forget it, making it easy to stick with the plan without watching the market obsessively. Remember, the key to success with dollar cost averaging is discipline. Avoid checking prices constantly and trust the strategy over time. This approach can make crypto investing less stressful and improve your chances of building long-term wealth. And that wraps up our deep dive into dollar cost averaging in crypto. If you found this video helpful, don't forget to smash that like button and hit subscribe. Let us know in the comments below if you're using dollar cost averaging or considering it after watching this video. Thanks for watching, and we'll see you in the next one.